Hello, hello. I hope that everybody can hear me right now. I'm not sure if you can, but I'm going to go ahead and start the live stream, and then I'm going to drop the link in chat, see if we can get this all started. Alright, should be live. Let me find. Looks like we have nobody on right now. Let me see if I can find it. Dinger is live. Nobody on right now. Let me see if I can find it. Dinger is live. Let me see. Test. Testing nobody audio. On right now. Let me see if I can find Perfect. It. I can hear audio. Sweet. I'll wait here for just a moment, see if we can get a couple people in, and then I will get started after that. Just as a reminder for everybody, this week the three things I'm going to be going into is token metrics and tokenomics that you can find on define.fi or DEX tools or different things of that nature. So as you see, I have pulled up right now the define.fi chart for Dinger. And we're just going to go into some of the data points that you can find here. Then we're going to go over some Etherscan stuff, tracking wallet to wallet things, looking at what data points are included in Etherscan transactions, and then a few other things in that space. And then we're going to go into my favorite component of the conversation that we're going to have today, and that is what type of innovation is Bitcoin? And that's going to be looking at that poll that we sent out and diving into some concepts found within that poll. Let me clear some of my windows here so that I have my notes up and I'm able to move forwards going slowly. And ideally a little bit more structured than last week, but we will be getting started in just a moment, replying to a couple people in chat. And I would like to see if a few people would get on here before I start. I can do it just talking into the wind if I need to, but it is always obviously more fun if there's some back and forth, some people that can ask questions about the things that I'm talking about. Gonna post some things in the chat real quick and then wait for people to hop in here. Hey, we got a viewer. Well, I will wait probably just another 2, 3, 4 minutes here. See if we can get a couple of the guys in. Would be sweet to at least get some of the other guys that admin and mod the chat like myself in here. All this time definitely brings value to the community getting us. Oh, it shows 3 of you are in here. Sweet. I'm only showing 1. But since J Moon said that, I will go ahead and get started. I guess the first thing I was going to say is we were going to talk about what is liquidity. And so the reason I say that is because liquidity is here. It's something that people ask questions about all the time, right? They're always wondering when they jump into a new altcoin or whatever, what's the liquidity? What's the liquidity? What's the liquidity ratio? A lot of altcoins try to get a ratio of about 1 to 10. Or 10% of their market cap as liquidity to allow the price to move efficiently in either direction. But generally, what is liquidity, right? So the available of liquid assets to a market or company. What is a liquid asset? A liquid asset, basically an asset's liquidity is how easily can it be converted into usable cash, right? So how close to basically being cash is that asset? So if we think about general assets, a house is what's considered an illiquid asset. It's not very liquid because there's a long sales cycle. If you own a house, you may own, say, $300,000 worth of value, but it's illiquid value because for you to access $300,000 worth of cash, you have to put your house on the market, get a realtor, or if you're a real estate agent yourself or a broker yourself, you can handle it so you don't have to pay that fee. You have to wait for people to make offers. You have to accept offers. There's an inspection period. There's appraisal periods. There's all these boxes that have to get checked before that house can be turned into cash, right? Stocks, crypto, are considered highly liquid assets because they're able to go from the asset to cash extremely, extremely quickly, right? If you own shares of a stock and you want cash, you can sell those shares on the market immediately. And so that's liquidity in general. So what does liquidity mean when we're talking about crypto or crypto tokens, right? So this liquidity metric right here is just the amount of Ethereum, right? The market that Dinger is. So I'll change it to the Dinger ETH market, right? The amount of Ethereum that's available in the liquidity pool that other people have put up. Basically, when you add tokens to a liquidity pool, what you're saying is I will buy any tokens below this value, because remember, you put ETH and Dinger as an example into the liquidity pool. So you're saying if the price goes down, use my ETH to buy Dinger. If the price goes up, use my Dinger to sell into ETH. That's what adding liquidity basically does to these protocols. So that's why it's hard to push a price if this ratio, was 50, 60, 70% of total market cap. That's people who are saying we'll buy anything below, so it's hard to push the price down, but we'll sell anything above, so it's also hard to push the price up. When these liquidity ratios are a little bit lower, it's a little bit easier for price to be changed because there's less tokens of ETH and or Dinger being sold and or bought at different prices. So we have 411K worth of liquidity. So what that means is that we basically have about $205,000 worth of Ethereum that are paired with $205,000 worth of Dinger, and that's the liquidity available. That's the market that's being created by liquidity providers for you to buy and sell into that market for whatever token it is. An easy way that you can see that is if you go to Etherscan. We'll get into this a little bit later when I talk about Etherscan. And I'm on just the Dinger tokens page right now. I'm looking at our total holders, right? And so we know that the Uniswap pool is right here, right? So there are 78 billion tokens of Dinger tokens in there, or $216,000 worth of value, paired with an equivalent dollar value amount of Ethereum. Let's see if we can see the Ethereum that's in here. Probably not. From here at least. There's roughly 104 ETH in the liquidity pool, right? So you should be able to, I know Dext does this a little bit better. They show the liquidity, the actual liquidity pool and what's sitting inside of it on theirs. Sorry, T-Bone, for leaving the defined space. Ooh, hate seeing Kitty there. So over here on the side, it's going to pop up the pool info in just a second. And we can see that 78 billion tokens with 100 Ethereum, right? So our liquidity is just the value of that Ethereum, which gives value to those tokens. So there are currently about 78 billion Dinger tokens available on the market to be bought for Ethereum. To buy Dinger, you have to add Ethereum to the liquidity pool and remove Dinger from the liquidity pool. That means now there's more Ethereum, less Dinger. So each one of those Dinger tokens represents a higher cost because there is more Ethereum paired with that less Dinger. So that's just a general high-level overview of kind of liquidity and what it's actually representing here. So when you see really high liquidity ratios, like 4 to 2.6, right? Or 400,000 to 2.6 million. So that's 4, 8, 12, 16, 24. So roughly 1 to 5, right? So the token is almost 20% liquidity right now. When a lot of people look at tokens, they want 10% or even less so that it's easy for the price to move. But also seeing higher liquidity numbers at lows is, in my opinion, a good thing, because it's showcasing, hey, there are a lot of marginal buyers that are adding liquidity. They're adding liquidity saying, if it goes any lower, I'm buying those tokens. That's why I'm adding this liquidity in here. So that's just general information about what liquidity is. Daily volume, you all should know volume is just the dollar amount of buys and sells that have occurred on the chart for that day. Something that you should pay attention to, a lot of tokens oftentimes can fake volume. Dinger has not been doing that. All of the volume here has been legitimate. There are other tokens that have functions that they can call that do random buys, random sells off and on, and they're not taxed because they take that wallet address away from being taxed. And they're trying to just spoof volume to keep exchanges happy. It's cool to see that Dinger hasn't been doing that. All of the volume here has been authentic and legitimate. Market cap. So there are two different market caps, and I believe what defined shows is just the fully diluted. Let's see. Yeah, and it looks like Dext also is just showing fully diluted as well as the circulating supply. So there's something important to keep in mind here when you think about market cap. So market cap is the amount of tokens circulating times their price, right? For circulating market cap. Something that tokens will do a lot of times is, and I don't have a good example of them because I only have Dinger up and they did not do this. You see how Dinger they took 6% of tokens for providing the initial liquidity pool, but then they put 94% of the token supply on Uniswap to sell immediately. So selling 94% of the tokens and leaving 100% of the tokens in circulation. A lot of times, let me see an example of a token that doesn't do this. I think I have one actually. Let me pull it up quick. Etherscan. And then we need to go. One moment. Sorry, I'm on a different browser right now trying to pull something up that I can bring over for you all. So we were talking about a token launched on the Dinger launchpad, right? The other day, Hype Apes. They're a token that launched on the launchpad. So what they did is they locked a Uniswap pool here, right? I can't remember exactly how many tokens they locked on it, but they held back a percentage of supply. It looks like 34 plus 37. I think this is their staking platform, so I do think that these tokens could circulate, but they're currently staked right now. So I really think this is the only tokens that are technically not circulating. They're set aside for things like centralized exchanges. They're set aside for paying for marketing programs and different things of that nature. But so these would not be included in circulating supply. So when you go to calculate the market cap of this token, you're going to see two different market caps, right? You're going to have a circulating market cap, which some people will post, like CoinGecko, CoinMarketCap, etc. And then there will also be another thing called fully diluted value or fully diluted market cap, right? If you're looking at the circulating market cap, what you will see is the price of all of these tokens below, everything that is circulating times the price of the tokens. If you look at the fully diluted market cap, it will include these non-circulating tokens when calculating that. So imagine if the price per token was $1, right? And there were 1,000 tokens. We're going to keep it really simple. So the fully diluted market cap of that token would be $1,000. 1,000 tokens times $1 per token. If we look at Hype Apes and we assume 34% of those 1,000 tokens are not circulating, right? So that's what, 66 tokens? 66% is circulating. So it would be 660 tokens times $1 is the circulating market cap. So the fully diluted market cap might show $1,000, while the circulating market cap can show $660 total, right? Or 34% less. And I'm using really small numbers so that it's easy to wrap your head around. But remember, when you put this on the grand scale, if you're talking trillions of tokens and millions, tens of millions, hundreds of millions, billions of dollar market caps, it can make a big difference. 30% of $1 billion is a lot of money and can be a huge difference. So something that I like to look at when I'm looking at a token's market cap is what's its circulating market cap and what's its fully diluted market cap. And in my world, if the fully diluted market cap is more than 20 to 30% more than the circulating market cap, it scares me because there are tokens floating around that are not circulating within the market. Something weird with live stream chat, T-Bone. It might be some people are not able to have their privacy settings changed or something like that. I'm only seeing a couple of individuals as well on my side of the stream, but I'm just going to assume it's not a big deal. And there will be a recording, and we'll be able to get this posted out later. But yeah, so I really try to make sure that the fully diluted market cap and the circulating market cap aren't abhorrently different. You know, it is something that I recognize tokens do need to be set aside for teams, for marketing, for centralized exchanges, for other things. But if there's a circulating market cap that shows 2 million and the fully diluted market cap is 100 million, I would run away because it shows me that the team has access to more tokens than are circulating. And this is something that transitions over to traditional equities as well. Something I encourage you all to look at is the float of a stock, right? So stocks are also similar to this. There's an order book that has liquidity in it at the current price that the stock is trading at, you know, and there have to be marginal buyers and marginal sellers to keep the price within whatever parameters or range it's going to be trading within. Not all tokens are considered circulating very often when it comes to stocks. Sometimes stocks have 10% floats, sometimes 2%, sometimes 30%. I mean, they vary depending on the company. It's something that's publicly listed. You can go look what percent of the float is out there. A lot of people look at what percent of the float is sold short. But the float basically just means how many tokens, how many shares are currently circulating and being bought and sold by people, and aren't just sitting in a founder's account somewhere, waiting on the back end to be dumped. That's one of the reasons why I like crypto as well, because a lot of this stuff is transparent, more transparent than it is with traditional equities or things like that. And a lot of times the circulating market caps for crypto tokens or crypto projects are a lot more representative of the fully diluted market caps that traditional equities will show. A lot of traditional companies have giant, monster, fully diluted valuations, but they only really target or showcase their circulating valuations because they're trying to pull liquidity from retail traders. And that's speculation, but something that I've noticed definitely for sure. But so market cap, make sure that you're understanding the difference between fully diluted as well as the difference between circulating market cap. Total supply gets listed here. I'm not 100% sure if they would list the total supply that's circulating or the total supply that's fully diluted. Dingers shows here as well on Dex tools, so not too different of data point there. Something pretty simple, and then ETH's price there. Another data point that you're going to pull off of Defined or Dext is what's the actual market that this token is trading against, right? So remember, Dinger is a Uniswap liquidity pool that's on the Binance Smart Chain as well as the Ethereum chain, right? So if you look at Dinger token, you can see there's two different defined pages for it because it has multiple markets. It's traded against WBNB, wrapped BNB on the Binance Smart Chain, or the BNB chain, I think is what they call it now. And it's trading against ETH on the Ethereum chain. So another data point that you can see when you go into defined is what is the actual market? What is the thing that this asset is being traded against? With traditional equities, you're typically seeing equity over United States dollars all the time. In crypto, that changes often because many markets are against crypto projects. Dinger is against ETH and against BNB. There are multiple markets for this token. It's not actually trading against the United States dollar, even though its value can fluctuate against the United States dollar. Its real markets are Dinger versus ETH and Dinger versus BNB. So that's another interesting, unique data point that you can pull is, okay, what market is my token or crypto project trading against? Down here, you can see the transaction list. It's good for a lot of random information like that, but not too much that I'd need to go into there. So that's just a quick and dirty overview of kind of what you see when you're looking at defined or DEX tools. Like what kind of data can you pull out of it, and what things do you need to pay attention to when it comes to liquidity ratios, circulating market cap versus fully diluted market cap. And I guess let's look at coin market cap. They might be able to do this. Since our circulating is the same as fully diluted, it just lists both. But some tokens, when they have a different one, right? This would be an easy way to see, oh, the market cap might be X, but the fully diluted market cap might be Y, because this market is, there's tokens that are sitting on the side for the team, or et cetera, et cetera, et cetera. So a good thing to pay attention to, the difference between market cap and fully diluted. But that's everything for the overview of token metrics and tokenomics found on DEX and defined. Just general, quick information, a little bit about liquidity as well. So I'm going to go ahead and exit out of all of these. And we're going to go looking at some Etherscan stuff. So general Etherscan reading, right? So let's start with here, I guess. We'll open this wallet. The largest holder... Oh, wait. Which one did I open? OXCO8. Yeah, okay, cool. CO6. Sweet. I opened the single largest holder of Dinger tokens here, holding about 4% of supply. So that I can show you, some unique ways to look at Etherscan and try to deduce information from it, right? So we'll look at just their last buy first, or I guess I'll go into data points. So balance will show you how much ETH is in this wallet, what the United States dollar of the ETH in that wallet is, and then you can also see all of the tokens that are held by that wallet as well. All of the ERC20 tokens, the 721 tokens, which are your NFTs, and then there's a couple other types of tokens you can see there as well. As you notice as well, a lot of these are spam. People can contribute or donate tokens or airdrop tokens to you willy-nilly, and a lot of times they are a lot of T-Bone reading your chat right now. Sorry, man, knocking me off of my flow, I guess. But so a lot of times when people give you tokens, they're trying to scam you. So just leave them here. Don't look at them. Somebody having a token in their wallet doesn't necessarily mean they bought it. Doesn't mean you should, if you're wallet tracking and you see up1.org in a Whales wallet, oh, I should go buy that, because it could be a scam. So take everything with a grain of salt, assume everything is a scam first, and work backwards from that. Always remember that our goals here are to gather data and make decisions off of that data. But so that's just a data point. You can see what tokens are sitting in this wallet at that wallet address. Now we're going to look into like what's actually shown. So when you look down here, what you're seeing is the method or the function that's called. Some are transfers. A multi-call is a type of transaction on pulling from a contract, but you're doing multiple calls, multiple functions are being called on that contract. A lot of times you'll see if you're doing more simple contract interactions, it'll just say swap token for ETH or swap ETH for token, and that'll be the function that's getting called. But so the method is just kind of what's happening here. Sometimes these will say approve. This guy is mostly just buying or transferring. He's not really doing too much outside of that. So that's why we see a lot of multi-calls, a few transfers. But other people, you might see a multi-call, a swap, a transfer, an approve, different things of that nature. When you're deploying contracts, the add liquidity is one of the methods that can be called. And so this is telling you what the transaction did. The transaction hash is going to contain all the internal data of that transaction. So it's basically going to say what happened. They swapped this much ETH for this much Dinger on this liquidity pool. They did it here. That's how many block confirmations have occurred on it. This is the contract that they were interacting with, and this is also the exact execution of what's going on. Down here in tokens transferred, it shows you each execution of exactly what's happening. They sent 0.269 ETH to the Uniswap pool, and they pulled out this many Dingers from the Uniswap pool. It was this much value exchanged. There was a fee associated with that transaction. The gas price was here for that day. You can even go further and see how much gas was burnt from this transaction after the new EIP went in. I think it's 1559. What your transaction savings were. You can see all of the input data here as well. Really, really cool stuff. If you added a note, you could see the private note. You have to log in or connect your wallet. But yeah, so that's just general information of kind of what's included in a Uniswap swap. And you can see exactly what's going on in there. So how does it get interesting when we use these wallets to let me think of how I want to phrase this. How do you use Etherscan to deduce information, right? So Etherscan, the blockchain is public. It's data that's broadcast publicly everywhere all the time. So everybody is always able to see. The person recording is putting messages inside this propaganda. I'm not doing that. There's no messages or propaganda in here, not trying to teach anything, just explaining how I look at stuff. But good to hear. So you can use this as a method of working backwards from transactions to determine information outside of that. You know, so this wallet is, let me look at all of their transactions so I can find the ones that are cool. I picked this wallet for a purpose. You know, Tony and them talk a lot about how they have done a ton of buybacks and different things of that nature, but they don't publicize it, right? So how could you know, people oftentimes say don't trust, verify, right? Well, we know that this is the marketing wallet for the Dinger token. And I'm going to go into the Telegram group really quick, and I'm going to pull up the command for marketing wallet. Everybody's going to see the wallet address pull up in the Dinger chat for the marketing wallet. And you can confirm that it's this wallet, right? It's public information. They posted this in their Telegram chat. You know, this is the dev wallet right here. They publicized this information in their Telegram chat. I pulled that up from the Telegram using the last two commands. So if you want proof of that, go to t.me/Dinger token, do the CAPTCHA, join the Telegram. You can see that the last two things pulled up were the marketing and dev wallet that the Dinger team publicly showcases so that their community can track, follow, and see what's going on behind the scenes as this team develops new things. So we're looking at the transaction list, right, of the single largest holder of Dinger tokens. And we come down here and we notice, oh, this wallet had some ETH given to it by the marketing wallet. I wonder if this might be that buyback wallet that Tony was referring to. And you can look on Etherscan and see, okay, here is the marketing wallet. Marketing wallet sent in ETH that was then used to purchase Dinger tokens. So this wallet is used as a buyback wallet to do things like fund Legends of Dinger. Something's going to have tokens. Remember, the team didn't do any team tokens. All the tokens are circulating, right? They're all out there owned by investors, not by the team. So the team needed a way to get tokens that they can use to fund Legends of Dinger, since it's a play-to-earn game, right? You're going to earn Dinger tokens. Those tokens have to come from somewhere, and the token isn't getting inflated on an annual inflation schedule that can be paid out to those players of the game. So there has to be a way to get tokens that can circulate within the ecosystem. Tony was talking about how the team brings revenues in from their new launches. They use those revenues sometimes to fund buybacks that will be utilized in the ecosystem. This buyback wallet isn't publicly listed, but you can use data found in Etherscan to track from other wallets, like the marketing wallet, to the buyback wallet. Oh, where did it go? To the buyback wallet. This is the marketing wallet again, isn't it? Whoopsies. To the buyback wallet here, right? So that you can say, oh, this is a team-held wallet, and they're using this for team projects to build the Dinger protocol. And now we know that we can sleep easy at night knowing that this large holder isn't going to dump tokens, because they're using these tokens internally in the game, using these tokens internally for other things, for token locks, for influencers, for whatever. I don't know exactly what they're going to use every token for, but they're not being sold. They're being bought by the team, and you can deduce that by looking at Etherscan and working backwards. There's so many different things that you can use with Etherscan to do some of this wallet snooping. I'm not going to go through and snoop everybody else's wallets and showcase everybody's wallets and who owns what from here, but I encourage you to go out and try to mess around on Etherscan. Look at the tools that exist and see how you can use the data on there to work backwards on maybe figuring out who owns what wallet, or who is using what wallet, or who's being sent what funds from what team, or et cetera, et cetera. And I'll just put this out there as well. NFTs, if you buy and own an NFT, it's a very identifiable piece of information. That NFT sits in a wallet somewhere. If you get on Etherscan and look around for that NFT, you might be able to figure out who owns certain wallets based off of the NFTs that they own. Etherscan is a public broadcasting of the data that's on the blockchain. They're showcasing all transactions, all data points that the blockchain has at all times. And it's a really, really unique way to look at and make decisions about different things regarding a token, and determining who's holding it, how they're holding it, how they're utilizing the protocol. But so that's all that I have for Etherscan. I'm not going to go too deep into that, but for the last thing that I want to dive into today, it's the one that I'm really, really excited about. It is looking into what type of innovation is Bitcoin. And so before I get started, I'm just going to do, I'm going to go through and explain my thought process here. So I sent out a poll yesterday, and after I sent out the poll, I shared it with quite a different number of groups on Telegram, on Twitter, etc., just trying to get as much data as we could. We had over 54 votes, which is a good sample size. It's not a ton, but for something this simple, we're just trying to get a general idea of how people think or understand the innovation that Bitcoin is, right? What we found is that now it's changed. So 35% of people think that it's a money/economic innovation as well as a technology innovation, both of those. The second place was a money/economic innovation alone, with 21% of people voting for that. In third place, we had tech, money, economic, and energy. It's all of them. It's all types of an innovation with 15%. So that was cool to see that at least in third, we had people think it's all three types of innovation. Technology alone, and then I don't know or I don't care, were tied for fourth place with 12% of the total vote. Energy alone got sixth place with only 4% of the vote. Money/economic and energy was in seventh place with only 2% of the vote, and that's what I voted for. I voted that it was a money/economic innovation as well as an energy innovation. And in last place, it was technology and energy with 0%, which I kind of expected. And so what I was really trying to determine here is that a lot of people that I hear speaking to me in the traditional world think about Bitcoin as a technology innovation. And in my mind, it's not really a big technology innovation. E-currencies, cryptographic proofs, using SHA-256 hashing, all existed and was tested long before Bitcoin came about. There isn't really much new technology that was developed for Bitcoin to exist. What was innovated was how old technology, cryptographic proofs, public ledger technology, etc., distributed computing, was pieced together to create a new form of money with a hard cap and a known emission schedule. Emissions can also be known as inflation. So I know people hate the word inflation, and hearing that Bitcoin inflates every year might be scary, but it inflates up to a point. There will only ever be 21 million Bitcoins in existence. And so if you remember last week when we had the conversation and we went on to, what was it called? Inflationchart.com. And we looked at all this, they're printing all the money, all the values fake. Bitcoin and the money are the only thing that have kept true, right? What Bitcoin aimed to do was say, okay, if you're going to keep printing all of this money, the blue line is monetary printing. If you're going to keep printing this money, we're going to make something, Bitcoin, that at some point you can't print more of. So you can print as much money as you want, but the money is the denominator. And if you keep printing money, the value of my asset priced in your denominator, in your dollars, in your money, will keep going up because the denominator will keep losing value. So it was a new form of money, a new form of economics that basically takes the power away from those who are printing money and utilizing it for anything, to fund wars, to fund infrastructure investments, to fund whatever they want to fund. You're taking the power away from them to make your asset that you use as money worth less over time by their printing, is my opinion what Bitcoin's innovation was. So seeing people say money and economic alone in second place, I agree with that. It is a money and economic innovation. What really gets me excited is that the monetary economic innovation utilizing proof of work that they created also creates an environment for intense energy innovation. So I shared a couple of articles with you guys before jumping on this live stream. One of them was this. This is a paper from 1921, December in 1921, so a little bit over 100 years ago, where Henry Ford talks about replacing gold and ideally what came after it, fiat, in large troves, but replacing gold with energy as its main form of currency. I encourage you all to read this article. I'm not going to read it, like I said. I just wanted to showcase you that this has been spoken about for hundreds of years, getting people off of a gold or a fiat currency system that allows those with their finger on the printer or their finger on the control of that monetary asset to lose their control. Henry Ford said that if they could make money tied to energy, that they could end all wars. That's what this article goes into talking about. Fast forward 100 years, right? Bitcoin is the key to an abundant, clean energy future. This article that I'm showcasing now is written by Square and ARK Invest. So there's a lot of issues with clean energy that a lot of people in the green space like to skim over or not pay attention to. They greenwash it, and I know it pisses a lot of people off. I love Bitcoin because it is a energy buyer of last resort that is looking for the most sustainable, efficient, and cheap energy that exists on the planet. So one of the big issues right now with like solar or wind energy is that when the energy is produced isn't when the energy needs to be used. Solar power, wind power are very decently efficient forms of producing energy, but you produce all this energy in the middle of the day on your solar farm when nobody's using it. So now you have to store and or transport that energy. Also, you have to think a lot of times solar farms aren't where the energy is going to be used. They're not in the middle of downtown. They're out in a big field somewhere. So now you have to transport that energy to where it's going to be used, and or you have to find a way to store it until it's going to be used because nobody's using the energy at that part of the day. There aren't a bunch of EVs plugged in charging at their homes from the end of the day. There aren't a bunch of people cooking at the same time or turning on their lights because it's dark or XYZ use of energy. Energy is used more, I believe, I can't remember, but in the evening hours of the day, and solar works most efficiently during the bright times of day. So Bitcoin, right? Where does Bitcoin fit into this, right? Where does Bitcoin fit into incentivizing people to produce more sustainable, clean energy? That solar farm, if they can't adequately store or transport that energy, I think it's like somewhere between 60 and 80% of energy gets lost in transit if you try to send it over a power line. If instead of transmitting that energy over a power line, they run a data center with ASICs mining Bitcoin all day when nobody's using that resource, right? They can convert that energy, that solar energy, into Bitcoin, which is a monetary asset. They bring that solar energy to the market immediately without losing that 60 to 70% transmission. Now there's an incentive for more people to build solar farms because they don't have to just leave their farm turned off half the day when nobody needs the energy, or they don't have to worry about having a leaky battery or transmitting the energy. They have a highly efficient manner of converting that energy into monetary value. Now they're incentivized to invest in creating this system. Taking it a step further, people are looking for ways to create more energy now and more robust and efficient energy now because there's more demand on the energy system. So there's a brewery up in Longmont, Colorado. They were told by their city that they can't get rid of their waste hops and spent grains into the local river. They were going to dump it somewhere, and the city was like, no, you can't dump it because it's going to end up in a river. It's going to pollute something somewhere down the line. It's going to off-gas methane. You're going to cause pollution if you can't get rid of this. So they built a highly complex system that basically now takes all of their waste products and turns that into energy that they're using on site in a distributed manner, and it offsets their electric cost. So they're now pulling less energy resources from the grid because they found a way to turn their waste into energy, which lowers the demand on the grid resources, which are typically pulling from oil, coal, or what people would historically call a more dirty form of energy. Now there's less demand for that grid energy because they're using their waste as energy. And that lowers the cost of accessing that grid energy for everybody else. That solar farm that was wasting 60 to 70% of their energy trying to get it to the grid, instead of sending it to the grid, maybe they're owned by the same company, they convert it immediately into Bitcoin, right? Now they're more profitable as an organization overall, that they can also offer that lower demanded grid energy that's being offset from these other people producing energy from waste sites. They can now say, oh, we're making more money from our solar farm that we don't even need to bring to the grid. We can lower prices on the grid and make it to where everybody can access their energy at a lower cost because the demand had gone down from a few of those industrial organizations. I don't know how this is all going to play out. But the thing that's exciting about this is that Bitcoin is basically a load balancer. It's a way to say, hey, when energy's not needed, you don't need to turn off your energy production. Just sell that energy to the Bitcoin network, mine some Bitcoin, earn higher profits for that time, and then when you need to use that grid energy, turn off your data center that's mining Bitcoin and run that energy to the grid and sell it to your consumers. Texas had a really, really bad ice storm that killed a lot of people a year or two ago. I can't remember exactly when it was. My family personally was out of electricity and nat gas heating for 4 days. They had a fireplace and a propane tank that they ran an indoor heater off of. That was it. That was all of their heating for 4 days during an ice storm because they didn't have anything better in Texas. If that grid operator had been in the reason they weren't able to stay operational partially was because their facilities to produce the energy quit working as efficiently in the low temperatures, but also partially because there was more of a load on the energy grid in general. There were more people wanting energy in Texas at that time than historical averages would have expected from those grid operators. If you had been running Bitcoin data centers on all of these grid resources, these people could have been producing profits hyper efficiently on the back end and have invested in creating a more robust grid production system that when the grid demand increased substantially, they could have turned off their data centers and had the access to the resources to send to these homes and give them the energy that they needed, right? So it's acting like a load balancer. And now it's actually happening. It's really, really cool. I encourage you all to look into the Great American Bitcoin Mine or Great American Mining Company. I can't remember what they are. The people running it are interesting. I don't agree 100% with everything that they say, but I agree with how they're approaching Bitcoin mining, energy production systems, and load balancing. So in the oil fields, there's what's known as stranded natural gas, right? When you mine for oil or dig for oil or whatever you want to call it, they're pulling up oil and crude or whatever, and then pumping it through pipes over to a different facility that can convert that resource into energy. When you do this, you've all heard of flaring or seen flaring, right? You create a lot of methane, a lot of natural gases on site that it's just not profitable to bring to the market. You can't put it in a tanker truck and drive it, or you're going to spend more money getting it to the market than you can sell it for. Currently, they light all of that nat gas on fire and flare it. Just light it on fire. And I think what I've read is you get somewhere between 70 and 80% burn of the methane into CO2 when you're flaring. So you're burning a lot of it, and you're getting a good amount of that greenhouse effect taken down by burning the methane into CO2. Methane is somewhere between 20 or 30 times more polluting than CO2 is, so you want to get that nat gas into a smaller, lighter form of gas like carbon dioxide. So that's what they do now is they just burn it. They light it on fire. Great American Mining Company basically said, hey, don't do that. Let me come put a data center on your oil field at your rig, and I'm going to run a methane generator. I'm going to get somewhere between 90 and 99% efficiency burning that methane into CO2 in this generator. But instead of just lighting it on fire, at the end of the day, you end up with a resource or an asset, Bitcoin, on your balance sheet. Now these people have more economic value coming into them as they can produce more energy. The goal over the long term is that we have better systems of producing and using energy, not just that we have, quote, green energy or green energy for all. It doesn't work like that. You need a hyper-efficient mix of energy production technologies that can be turned on and off and utilized in efficient manners to bring people the resources that they need. Bitcoin is providing that through so many innovative ways and so many innovative companies that are trying to figure out, where can I just plug my data center in and bring more economic value to those people thinking about how to efficiently produce and bring energy to the market. One final thing that I want to say about load balancing and where Bitcoin comes into play, and kind of the risks we're running over the next 3 to 5 years with EVs. And like I said, I'm not going to read this article to you. I shared it in chat, and I didn't even really summarize it. I just kind of went into some high-level topics that are discussed in here, which is load balancing. But please read this yourself. But so EVs, right? EVs are awesome. They're cool technology. Not hyper efficient right now. Gas internal combustion engines are slightly more efficient currently than EVs, but things are starting to change in that space. But something to think about, right? Energy is energy, always. To charge your EV, you pull energy from a grid resource somewhere. That energy was produced using either solar, wind, nuclear, or coal, oil, or nat gas, hydrogen, any other form of production. It can be produced however. But that energy still has to be produced, right? Internal combustion engines produce the energy inside the vehicle, right where it's being used. You have the fuel, which is the oil, sitting in your gas tank, and then the energy is produced in your engine as you're using it. All of these EVs, there have already been rolling blackouts a lot of times in some of these higher density EV spaces, because at night, everybody plugs in their EV, right, when they go to sleep. Now the grid has to take over providing all of the energy production that used to occur inside of your engine from the oil that was in your gas tank. All that same amount of energy needs to be transferred into your car to be used from the grid. Grids can't handle it yet. If every person in America owned an EV right now and they plugged their EV in tonight to charge their battery, you would have blackouts nationwide because the energy grid cannot provide enough produced energy to charge that much demand. So as more EVs come on, we have to find better ways to distribute the systems of energy production across the grid so that we lower how much demand each household has from the grid, each warehouse, each industrial site, lower the demand that each of these entities has from the grid, so that when everybody has higher energy needs over time, the grid is capable of meeting that need, because it's not currently. We need more systems of energy production so that we can meet the demand that will be there over the long term as more EVs get plugged in, as appliances pull more energy. We as a species use more energy every year. It's rude and crude to tell people that one form of using energy is more moral or ethical than another. Is Facebook's data center burning hundreds of thousands of kilowatt hours of energy all day, every day? And I pulled a number just totally out of thin air. I don't know how much Facebook's data centers pull. But does that data center that allows a business to hire people and have social media and share content and connect people across the world, does that data center, its energy usage, is it more or less ethical than the energy usage of a Bitcoin miner or of an Ethereum miner? Is a gamer using their GPU to play their video game at night, or somebody watching a movie, or somebody doing XYZ with their personal life, is that okay to say, hey, Bitcoin's immoral because it uses energy? No. Bitcoin uses a lot of energy, yes. but it also uses energy in such a unique way that it can be the load balancer to provide economic incentives for grid operators to create more production facilities that are more efficient, so that as we as a species continue to use more and more energy, we have better mixes of energy production that can meet the need at an economic and feasible cost for the market, so that humans can continue to live and exist and use the energy that they want in their lives. I personally am a huge proponent of nuclear, wind, solar, hydrogen, biofuels, any type of natural gas, and oil and coal. All energies, all resources that can be used to produce energy have a place in our production mix. But Bitcoin allows us to start to think about, how can we create an efficient mix so that we're not just wasting energy or producing energy that can't be stored or sent to where it's going, or producing energy on a solar farm that we give up 60% of the energy efficiency while we transport it. Why not keep that 60%, mine Bitcoin, but then have a biofuel reactor close to where the energy needs to get used, or an oil generator or an internal combustion engine running on oil or gas close to where the energy needs to be used, and pay maybe a little bit more for that energy because you got the really efficient Bitcoin mined on your solar farm. This economic tying of energy production resources together as a load balancer is, in my opinion, the big innovation that Bitcoin brings to the market, and is what's going to let us take the next step as a society into an abundant energy future where everybody can afford to utilize that energy. So that's basically all that I have. I see a decent bit of questions in the live chat, and I don't think I'm going to be able to keep up with any of it. I'm not going to read through that. I was planning on having questions in the Dinger chat, but totally get that it's probably easier to do in the live chat. So next time I'll try to monitor the live chat better. But if you have any questions, go ahead and drop them in now. I'll leave this open for another 3 or 4 minutes. We've been running for about an hour now, so just drop any questions that you might have. And I'm happy to answer them. If you don't have any questions, though, I appreciate you all taking the time to listen to me ramble on about energy, tokenomics, as well as a little bit of reading Etherscan. I appreciate your time, and I hope that you all will like, subscribe, and please share this video. Drop some comments in. I've seen a lot of them into the top chat, but dropping actual comments into the post might help us get more viewers over the long term. But it's really exciting seeing that we have 10 people watching right now, and it's hopefully going to continue growing. Our total group of people that come to hang out with us and learn things week over week. But it seems like there's no questions. So with that, I'm going to go ahead and stop the stream. And I hope you all have a really great Sunday, and excited to tune in next week. So if you have any recommendations on what you want me to talk about, drop them in the Dinger chat, drop them in this chat as a comment. Whatever's easiest for you, I'll take a view at it, a look at it. I typically am going to go into topics that I feel confident about and that I feel like I understand at a level of depth. So if you post something that I might not understand too well, I'll do research and I'll get to a point of competence with it before I try to do the lesson. So feel free to drop things week after week if I haven't gotten to speaking about one of them. But thanks again, everybody. I'm going to go ahead and hit the stop button right now. Appreciate your time. Again, make sure you like, comment, subscribe. Please make a post on Twitter, share the recording of it. Let's get as many people to look at this content as possible, and hopefully we can fix the issue where people think of Bitcoin as a tech innovation and start helping people understand how it's a monetary, economic, and energy innovation. Making sure that we save the narrative, save the messaging from all these, keyboard warriors that are losing the forest for the trees right now in saying that Bitcoin's going to, ruin the planet from how much energy it uses, because that's not what's happening. Bitcoin is using a lot of energy. Yes, we can admit that, but it's also creating incentives to create a more robust and efficient energy grid going forward. So thanks again, everybody. Hope you have a great Sunday, and